discuss the money market in general. So what is the money market? It's a collection of short-term debt securities where people who want to park their cash into something that earns a little bit more than a checking or a high interest savings account, but you still have your money very liquid. So it's a good place to keep money if you have, let's say, a deposit on a house. I mean, is it risk-free? No. I mean, during 2008, there was a real risk that the money market could get in trouble, but generally it's considered pretty safe. What's going to be composed as part of the money market? So you're going to have treasury bills, which are risk-free, right? And I guess you do still have a little bit of interest or reinvestment risk, but I mean, it's not much. So you have treasury bills. Then you have T-notes and T-bonds that are in their last year of maturity, right? If they're in the last year of maturity, they're essentially T-bills, right? Then you have what are called jumbo CDs, right? You have regular CDs that are basically issued by a bank, and then you can only redeem them with the bank, and then you just get penalized if you redeem them early. Jumbo CDs, they're negotiable, meaning you could resell them to other people. Usually they're going to be $100,000 or more, and oftentimes in increments of $1 million. So they're for big institutional money. And generally, a lot of institutions will keep their money in money markets. Unless you're very, very wealthy, most people aren't really going to keep their money in money markets. They'll just keep them in a high interest savings account or something like that, but institutions will. So you have jumbo CDs, the negotiable ones, not the redeemable ones. Negotiable means you can resell. Redeemable means you have to sell it back into the company. Repurchase agreements and reverse repurchase agreements, I had addressed that in a previous video. We also have in there, we have what are called bankers' acceptances and commercial paper. They both have similar maturities of like maximum 270 days, but bankers' acceptances are often, 180 days or less. But they legally can have a limit of 270 days, which is about 9 months. Commercial paper is short-term borrowing by large companies for usually for working capital, which is like current liabilities, basically a year or less. It's usually going to be in large increments, like under state law. In order to be exempt, it has to be increments of 50,000 or more. So it's going to be for short-term borrowing. The reason it's around and there's a carve-out for it is because otherwise, if companies had to register every time they wanted to borrow money, it would just become a nightmare and they just wouldn't even do it, right? Then you have bankers' acceptances, which is a letter of credit used for international purchases. So, for example, if you were doing business abroad and you wanted to buy, you wanted to buy $20 million from a supplier abroad, you might not feel comfortable wiring them the money, but you go to your bank and say, hey, can I get a banker's acceptance? And they'll just say, hey, this guy's good for the money, right? So it's going to be really secured by you and the bank, right? And technically you're the issuer. And then obviously you can use it as payment, and you could trade those and stuff like that. So really those are the main components of money markets. If I miss one, maybe I missed one, but I doubt it. But please like and subscribe to the video and enjoy your day. Thanks.